All right, let me run through that again. What you didn't see. I need to do the weekly chart, don't I? So there's the weekly chart showing the channel, the negative channel, the break below the fib, the shorter term fib, which I'm going to have to crunch up now. So that fib is taken from the low of this year, which I can't see because the bottom of the page is now is now lower than it should be. Oh, come on. Right, maybe that'll work. Okay, there you go. That's the bottom of the page with the slow stochastic on it. So this goes back to 2015. Then you get your double top that I talked about, which I'm not going to repeat. Then you get your break below the 38.2% fib of the Fibonacci line that goes back to 2015 and the 200-week moving average. We didn't close below it last week. We've certainly plunged below it. And I just talked about the 23.6% fib, which is the one that goes back to the year 2000. Okay, is that all clear? Hang on. Where am I? Where are you? I need to make sure I'm watching the live chat. Right, you come over here. Right, you can see it now. Okay, now I've got the live chat in front of me anyway. Okay, so and now I'm just going to isolate the bear trend. Oh yes, this is what I said to you. A double top is only actually completed when the neckline of the double top has been broken. So that has been broken. So if I remember correctly, we should basically go down that measured target. I'm not sure if that's going to happen. I think that's overextending things for gold, really. But I do think that gold will go down. We've also broken the this trend line here, and we broke this was just a little bear flag. You know, it all looks very negative to me. And I think we're probably going to 1580, 1560, 1555, something like that. As I said, I think we'd have to beat last week's high, which was 1688, for me to change my mind and consider that gold is not going down. Okay, if you want me to look at something, like I can look at silver. I'll just quickly get it on the screen, but there's nothing really as interesting, if I'm honest. This is clearly in a bear trend. That trend line is definitely working. The one that goes back to June, but there isn't as clear a pattern at all in silver. I'll get the weekly chart up. That's got way too much on it. Let's just get rid of all the fib lines and everything else. What I should probably do is just take that. I mean, this is really quite all over the place, isn't it? So there was a time when silver was quite clear, but now it's kind of all over the place. I'm not even going to bother with that. It doesn't make any sense to me at all, if I'm honest. So let's just stick with gold. Now then, I'm going to look at oil because there are some interesting developments in oil. Right, there's the oil chart testing the 100-week moving average. We've broken this trend line, and it is an important trend line. This has confused me. Remember when oil went to minus 40, which was just insane? I didn't know whether to take the Fibonacci level from that low. I have done, and I think it's relevant. And it's quite interesting that the 38.2% fib coincides so beautifully with the 500-week moving average and the 200-week moving average. So I wonder if we'll get there. If we do, that should be one heck of a support area around the low $60 area. And I suppose there's a good chance that we will get down there. But for now, we've broken the trend line here, which goes back to 2020. So, you know, decent 2-year trend line. We did hold it initially. We had a decent bounce off it 2 weeks ago. We held it last week. And then, of course, the big red candle this week shows that we have broken it. And we've gone down to test the 100-week moving average. We're oversold on the slow stochastic. We are coming into some support. We've got the 500-day moving average, which can work as a good support level. Now, look, can I find some examples of it? There you go, look. If we go back, not spot on, not to the pip, but the 500-week moving average can do a good job of being a fairly general support area. So there you go. Well, a resistance area, that kind of worked, I suppose. It wasn't particularly accurate. Going back here, it did do a bit of a job there. Anyway, actually not as accurate as it should do, really. 500-day moving average can be a lot better as a support level. Let's just have a look. Going all the way back to, that's just sideways, so that doesn't help us much. 200, you can see the red 200-day moving average doing a phenomenal job there in 2015 as resistance here, and so did the 100 here. So maybe the 200 works a bit better in oil. Look, 200 really doing a great job here as a support level. So, and not too bad as a resistance and support there. So yeah, it looks like the 200 is the one that really works in oil at the moment. Look, beauty there, caught the low nicely. Where are we up to now? 2018. Not moving averages don't work well as support and resistance levels when markets are going sideways. They're fairly useless. But the 200 again really was the one that did the job. And then off we go. Then the 100 starts to kick in on the bull trend. Okay, that was just actually for my own interest to see which one was working. Where are we now? Let's try and get back to today. So we have a combination of well, we've got this little down channel here. I'm not finding this chart easy to read, I'll be honest, and I don't really trade oil. But I'm focused on the down channel here. That's what we seem to be. That is the pattern that is relevant. Put it that way. We're going head down towards the 500-day moving average at $76, and we've got the 100-week moving average at 77.50. So I guess I could say 77.5 down to $76 is the important range this week. I know that's a little bit wide, not particularly useful, but we'll see if it holds. I've got a feeling we will, but who knows? I can't really say any more on that. Now I'm going to look at the dollar index, which won't take me long to analyse because basically all it's done is go absolutely through the roof. You know, I mean, markets were really in. Let's talk about that actually. Markets we're just in panic mode on Friday. Now I don't know how long you've been trading for, but as you know, I've been doing this since 1987. I actually was on the floor of the London Stock Exchange in 1987, watching the crash, and I didn't know what crashes were. I was only 19. I was training to be a broker. And then everyone's going, and all hell was breaking loose, and people were running around the stock market like loonies. And we had stacks of orders that we couldn't even fill. And I just was like, God, is this what it's like all the time? It was crazy. And so I've seen everything since 1987, which I didn't really understand what was going on. But then I started trading, and I was trading some of these markets. Now you just get this feeling. Markets just change. They just go into sort of panic mode. They go into free fall, and this is what happened on Friday. And I don't know. When you look back at the chart, doesn't look that bad, but it really did have that panic feel to it. And I think this is going to follow through into next week. And I don't know. Next week could get really messy. Maybe I'm wrong. I've just got a feeling that the markets are starting to be in panic mode. And I think the first thing that happens is liquidity dries up because people just don't know what's going on. So you're used to seeing, good volume at every price, and the markets move quite orderly. They can be random, they can be erratic, they can move in sideways ranges, but the volume is always there. And what you may not have seen if you're quite new to the game is that when panic sets in and people don't know what the hell's going on, the banks, the big banks, the funds, everyone, they just step back. They don't want to know. They don't want risk. It's all about capital preservation. So you start seeing moves that are just all over the place because there's just no liquidity. So if a big order comes into the market and needs to get out, you just see prices vacuum. And it's quite frightening, really, because you just don't know when it's going to stop. And I'm going to talk a bit more about this because there is a good chance that the stock market crash is now coming. I mean, it's not hard to predict, is it? The global economy is obviously heading into, it is obviously collapsing. Right, dollar index. Let's have a look at the weekly chart. Just through the roof. So the dollar is the only safe haven at the moment. This is another bizarre situation that I'm not really used to. So of course, bond markets are usually the safe haven because we know that the US won't default on their bonds. Your money is safe there. You'll get a return. But of course, the bond market is not the safe haven. This week, the bond market actually went into free fall, which I haven't seen. Well, I suppose I did see over 2008, 2009 when liquidity completely evaporated. So that's the first time I've seen the bond market do that in 13 years. And I wonder if that liquidity is going to be an issue next week. And if it is, then we don't know how high rates will go, how far bond yields will go. And of course, the higher they go, the more the stock market is going to absolutely poo itself. Because if you can go and buy a bond that's going to give you 5.5% or whatever it is, I know the bond yields aren't quite there yet. We'll have a look at that in a minute. But say they get to 4.5%, 5% next week on the 10-year, then of course, what is the point in owning stocks in this environment if you can actually go and get yourself 5% return? So stock markets should absolutely collapse. Okay, so there we go. Bond yields. We beat the previous high, and look at these yields. I mean, look, that's just through the roof. These bond yields. Sorry, the dollar. So that really is the only safe haven at the moment. You know, and even at this late stage when the dollar has gone up so much already. Where's my cursor? There we go. Oh God. There we go. We're now seeing actually accelerated gains in the US dollar, and I don't see anywhere. I don't see how the dollar is going to stop that move. When I look at the yearly chart, or no, let's start with the monthly chart. There is just no reason for it to turn around. You know, clearly we've just had a massive move last week, accelerated. It actually just seemed to be accelerating to the upside. So this, and you know, that's another indication that actually panic is starting to set in. You know, it is a case of what the hell do we put our money in to be safe? And it used to be gold. Gold used to be the classic safe haven, gold and bonds. But I think gold will go down. Oh, that's another point. Sorry, all these thoughts going through my brain. I think it was a global financial crisis, or was it one of the more recent stock market moves? It may have been the COVID crash, as I call it. You know, gold should have been the safe haven, and it did end up being a bit of a safe haven. It did eventually turn around and go up, but initially gold absolutely collapsed, and that was because stocks were dumping, and it was literally a case of we have to liquidate everything because there were margin calls all over the place. So you know, I don't know, whatever, banks, brokers, funds, whatever, they were getting margin calls because the stock markets were going down. So I assume they were just going to liquidating anything. It may not have made any sense to sell gold because gold was it did act as a safe haven later on and push up significantly, especially when QE was introduced and then the market was just flooded with liquidity. But initially, gold absolutely dumped. And watch for something like that to happen again. If stocks start going down aggressively, there will be some really weird things going on. You'll be thinking, why the hell is gold collapsing? But that will probably be because there will be a margin call and someone will have to just sell something that they own. Would I sell stocks if I was holding any? I'm going to get onto the stock market in a minute, or a little bit later on, and I'll show you what I'm thinking about the stock market, and I'll show you why I think it could be now about to crash. And tomorrow morning or tonight, whatever, when the stock market's open, I think bang on the open we'll get an idea. But I'll come to that shortly. Okay, so dollar index. You know, this is the yearly chart. Maybe that's being a little bit. I can probably get away with a monthly chart for some data. Can I? Really, I'm just going to be looking for where we can get to. Okay, so this is a fairly obvious one. This is the 2002-2003 high. So this is the dollar ramping on the dot-com bubble. That burst in 2000, didn't it? So anyway, look, where's the dollar index here? 121. So 120, 50, 120. You know, I think we could get there. I don't really see what's going to stop us. The dollar certainly doesn't seem to be in any mood to stop. Look, we literally closed. Okay, we closed 3 pips off the high of the week. So it's not like we went up, retraced a little bit. You could say, oh, you know, we might be pausing here. We're so overbought, we might pause. There is none of that. This dollar is absolutely roaring away, and it seems like I can't see another safe haven in financial markets right now. Okay, so we'll see if that continues. But that is indicative to me of panic as well. Dollar pushing to the 120 level. Yes, Hemraj. Exactly, that's what I'm saying. So, okay, you got there before me. So, and I think that's where we're going. And yeah, as I say, we are in panic mode. We are just starting to be in panic mode, where moves are going to get parabolic now, I think, or they're just starting already to get parabolic. Okay, so this is the 10-year T-note. Okay, this is actually much more orderly, isn't it? And actually, we've got a more of a neutral candle on Fridays, which I didn't see. I haven't checked my charts before I did this. A very nice orderly move. Daily chart indicating maybe a little bit of exhaustion. But I wouldn't be selling bond yields on that. That's for sure. Okay, that's too much. But when you go to the weekly chart, you know, green candles all the way. Still a big green candle. Okay, we didn't close right at the top of the green candle. Let's have a look at the yearly chart, and I'll try and break down, see if there's any fibs or anything that I should know about. Here we go. Look at where bonds have gone from. Look at bond yields. Look, 1982. So I started my career in 1987. Where was that? Here. So the high for bond yields was 10%. So we went from 10% to basically 0.3% during my career so far. Right. Oh, okay. That's interesting. We are actually, my bond yield data goes back as far as 1953. So bonds started climbing as the global economy grew, and then from 1981, bond yields just trended lower. Whew, that's incredible, isn't it? So anyway, we are now at 3.97%. We are looking at the first 23.6% fib resistance level for 10-year T-note bond yields. And when you look at the price action as well, swing low here. Okay, we did get below it there, but you can see these little spikes are just about holding it. There is, and these candles here, there is reason to believe that sort of 3.95, 4% should be a good resistance level in bond yields, in T-note yields. So watch that during the week. We start getting up through 4%. That is going to be indicative of some serious panic. And I didn't know that before I showed you today. So that's quite interesting for me as well too. That's all I really need to say. If things do calm down, then obviously bond yields will start to ease off a little bit. But at the moment, it does feel like markets are getting into panic mode. Okay, so I've done bond yields, I've done the dollar index, I've done gold and oil. I might as well look at the euro. I'm just going to go through a few Forex pairs, the ones that I commonly look at. But if you want me to look at something else, then obviously let me know. Now, the euro isn't really that old, is it? What is it? 25 years old? So I've got data going back to 1975. Oh yeah, okay. So that's probably, and we are. Actually, I need a weekly chart. So we have broken a lot of levels in the euro. I'll start by joining these little lows. There we go. Why have I got that all scrunched up? That should be up here. There we go. So the fact that we've broken, this is 2002, joining 2004. So it's a decent trend line, and it did do something to hold the price here. It did, did do a little. We bounced off it initially. That was back in July. We broke below it, but we had a green candle, and we managed a recovery here. But of course, last week absolutely annihilated. So that's it it's good night for the euro by the looks of things. Further significant moves to the downside. I'm going to have to look at the yearly chart if I can try and find some targets. Is this trend line relevant? Okay, wow. Okay, this is the yearly trend line going back to 1985. The low here in the year 2000. The low here in the year 2017, I don't think I would have seen that in 2017. We bounced off it then. We bounced off it in 2020. So we can call it, well, this was the line that would have given us the trend line back in 2000. We tested it again in 2001. We tested it again in 2002. So that was a very well-established trend line after that. And then we tested it again, as I said, in 17 and in 20. And now in 22, we've broken it. And we've really broken it. So I've used some Fibonacci extensions to figure out some targets. That's what those lines are. Now, the first target is 95.75. So we're not far off that at all anyway. We're at 96.66. So it looks like we've got 90 pips on the downside. Anyway, that would be the first target. And I'm guessing we'll see that next week. That is just what I've done there, by the way. I've just taken this last big swing. This was the last major swing up that we had in 2000. What was that now? 2020 up to 2021. Okay, so that was the whole 2020 recovery. I've taken the zero line and the peak, and I've put my fibs on there, and then I've got these Fibonacci extensions which come down here. That's how I've got it, in case you're wondering. So that's the 161.8% fib of that 2020 rally, in case you want to put it on your chart. I hope that makes sense. So that looks like where we're going now. It gets more and more difficult for me to project after that, if the truth be told. if we do break below there, does anyone want to know where we could go? I suppose I should really tell you. Oh my gosh. Okay, we're going back to here. Where is this now? 96. Oh, I need to actually open this up. Okay, so we're going to be back around the 0304 area. So that's sort of 90. We start breaking below 9600, and that's going to get really, really messy. Okay. That is going to get so watch 9600. That for me is the next major area for the euro US dollar. As I said, I think we're going to 90. Oh, hang on. No, my fib level is at 95.75, isn't it? So we break below 95.75 and it's going to get messy. That means we'll have broken that congestion area in 2003, 2004. Wow, we're dangerously close to that. That isn't going to be good. I think we're going to break that, if I'm honest. We've got such good momentum to the downside. Okay, yeah, it's a real messy market, really messy. Aussie dollar, you know, the dollar is obviously surging. There's not really much I can say about dollar pairs now. If you've got any questions, I mean, do you want to know which one I would sell on Monday, or has anyone got any dollar positions on that they want to talk about? The Aussie US is about to test an important fib level. So if you've got any interest in the Aussie US, it looks like we're going to 64.60, which isn't far away at all. It's 60 pips, so that's nothing. If we start breaking below 64, what's the low of this candle? 64.00. Okay, well look, 64.60 to 64.00 is the only resistance for the Aussie dollar at the moment. Break below 64.00, we'll have well broken the 61.8% fib and the low of this nice big red candle that goes back to 2020, and then it's good night for the Aussie, because that is going to come down quite significantly by the looks of it. And the New Zealand dollar has already got quite significant momentum to the downside. If anything, it looks a lot weaker than the Aussie. Look, okay, this is now well on the way to 2020 lows as well. So, you know, there's nothing else I can really say. Canadian dollar, this has been good to us. Nice little trade for us on this one. I spotted the fact that this consolidation was absolutely horrible. I really hate these kind of sideways markets. I don't, you know, they're really frustrating for me. Anyway, fortunately, now, where was my thinking? I'm going to tell you what my thinking was on this one. Okay. This was actually the daily chart that I need to show you. This was my logic behind this. This is all about moving averages. So moving averages are of no use to us really whatsoever in a sideways trending market, other than to confirm that we are in a sideways trending market. You know, eventually all the moving averages converge, and then it's only when they start to fan out that you then think, oh, okay, maybe we're starting to trend again. So we converge, we trade sideways. I mean, up until this point here, this first half of the sideways trend was obviously very much a sideways trend. The peaks were pretty much all lining up, and the lows were lining up. And then it was after this low here, that we started to build something of a bull trend. Can you see that? And the indication was because we held the 200-day moving average on the downside. Instead of breaking below it like we had done previously, we held the 200-day moving average. So that was when it was worth putting in a trend line and thinking, okay, hang on, is this the start of something? Now, I didn't get aggressive about it here. I didn't really know. Of course, I assumed that we would retest the trend line up here, which we did. Now, I'm pretty sure I recommended a short there. I mean, I would have done. Why wouldn't you have done? And the market then pulled back. And it didn't pull back. It pulled back to the 50 and found support. So the moving averages are starting to do their job now. And that's telling you, hang on a sec, we might actually be starting a trend. And this is when I started to get excited. So that's when I put this trend, that was when I put the trend line on here. I had this first trend line on here. Then I put the second trend line on here. We held the 50. I thought, right, hang on, we might actually be starting a trend here. But you don't know until we've broken above the trend line properly. Okay, and this confused me, obviously. We had these peaks up here. I thought, oh, you know, I'll be honest, I thought, okay, here we go. Now we're going to enter into a really irritating sideways trend here, and before we break up. but we didn't, and this was quite nice because hopefully, did anyone get on this trade? As you can see, I only got on it on a small amount, but this was nice. Once we broke up, then we ran, and we even had a retracement to the trend line for us to jump in, and now we're off. So, and that's been really good. It's been nice. This is what I like, when you finally spot something like this and you jump on it and you just stay with it. So, the dollar CAD is a pair that are late to the game really in catching the dollar move. So this might actually be. So, I mean, I'm hoping. Is anyone still holding longs in this? By the way, if you are, just give me a yes or something so I know. If you are still holding longs, I've still got them, as you know, and I'm just going to keep holding them. We've got to get through the 61.8% fib, which is at 136.58. Now I'm showing you this on the weekly chart. You can see that oh yes, that was a level, wasn't it? 130.35, because we test. Oh no, that fooled me if I remember. That one fooled me. I thought we were going to hold it and then we were going to go, but I think we broke below it and we went off. Anyway, we're off, and this could be something quite serious. I'm hoping this is a trend that really, really moves. Now, in theory, you're supposed to move the width of the consolidation, aren't you, of the channel? So that takes us, I think, up to. Oh, hang on, I'm doing this with my fingers. That's how technical I am. Okay, with my fingers, very high tech here. If we get through 136.58, the 61.8% fib, we should get up to 140. So that really is my target. I don't think we're going to pause at 136.50. I don't think we're going to turn around from 136.58. We might pause, but there's nothing else there. There's no trend line. There's no real price action there. There's obviously no moving average and there's no trend line or whatever. So I just don't think that is going to be a factor. Oh, we do have a swing high up here. What's that at 136.64? Okay. I'll pay a little bit more attention to it now I've seen that. Maybe that's significantly higher, isn't it? We may pause there. I'm not sure I'd be selling into a short position, but if we start breaking up through sort of 136, what shall I call it? 136.80, then we could jump to 140 to 141 quite quickly. I'm going to take a gamble there. And I'm going to hold on to the long position and see if I can really run this thing, because it's only small anyway, so I'm not really bothered. I'm only up about 500 quid on it. Talk a bit about the yen. Okay, yeah, that's a good idea. We've done the dollar. Let's look at the yen. Well, the dollar yen is the one to start with, because obviously that's the major pair of the major. Right. So now the Bank of Japan intervened. Wow, that was punishing for me. I got us into a long position, didn't I? Where did I get us into that long position? I think it was on the 4-hour chart. Can anyone remember? I could go through the Telegram channel, but I can't be bothered. It'll take me forever. So just before this happened, we got into oh, whoops, what's going on here? Just before this happened, we got into a long position, didn't we? And we were up about 100 pips, so it must have been here. Yeah, it was. We had a dip to that trend line. Yeah, that was it. That was it. Okay. Why is this doing funny things to me? Okay, yeah, that was it. So we had a really nice consolidation. I'm going to talk you through this one. Right, dollar yen in a massive bull trend. We know that the dollar has been strong. We know why the yen has been weak. No chance of Japanese raising interest rates when the rest of the world is. They're happy to see low rates, and I don't know if they're still doing QE or whatever, but anyway, they desperately need inflation in their economy. So we had what appeared to be, forgetting this wild move here, we're just a very clear consolidation. A flag, maybe a triangle, rising triangle, whatever. We had the breakout, nice and easy. So I got us into a long position on the day, on this little dip back here. Happy days. Very quickly, we were, well, you can see from the hourly chart, very quickly, we were up 100 pips. And I was patting us all on the back going, oh, wasn't that a nice trade? I didn't get out. I pointed out to you guys that we were up 100 pips. I pray that you guys got out, because I didn't. I had a stop in just around here, and it was really weird because I didn't know what had happened. I was, don't know, in a meeting or something. I've looked at my screen. I've gone, where's the dollar yen pairs? I didn't have a target in there, so I couldn't understand why the trade was not on my open positions. I was like, I was up 100 pips a minute ago. Where's the trade gone? I knew I didn't have a target, so I knew I couldn't have hit the target, and been taken out with a profit. So the next thing I've seen this, and of course Bank of Japan's intervened for the first time in I think it was 25 years. So look, that was pretty successful. They've definitely put the shits up the market, and right now we're trading below this trend line. So from a technical perspective, they've done a good job. They've really, they've created one hell of a bull trap, because that is a 500-point move, pip move to the downside. If you were caught on that bull trap, I think you're going to be pretty happy to be getting out here, aren't you? You're going to be, if you got caught on that, even if you got in here and you didn't have a stop in, you'd be happy to get out here, wouldn't you? Because we've had a 300 pip recovery. So I think this could be the peak for now. The market has tested the resolve of the Bank of Japan, and they obviously are prepared to defend the currency now. They've obviously thought they've had enough. So this is quite a key level, sort of around 130, 143.30, 143.50. But if we get up through there, I don't know. Maybe we can retest this area up here, 144.70 area, which is the 78.6% fib. I'm guessing that would happen because this is kind of no man's land to me now. If we get anywhere near that, of course, people are going to be petrified. The Bank of Japan is going to do something similar. So I think they've put a floor in there for the time being. I think they've done a really good job. And I say a floor, a ceiling for the dollar yen anyway. And it's actually only the dollar yen that is still looking quite strong. So it's more dollar strength now than yen weakness. So I'm guessing probably dollar yen maybe more of a sideways pattern. But when you look at other pairs, it does show that actually the Bank of Japan has done a pretty good job. So let's look at the Aussie yen. Now the Aussie's weakening anyway, so with the yen stable now and the Aussie kind of weakening a little bit. Whoops. Now the Aussie yen has actually got a really good support level here. So if you are trading that, or you want to be at least aware of it. Again, I've just taken the swing low from, this consolidation pattern here. So we went up, we had a consolidation. This is what I should really do. I should put my fibs going all the way back. This is what I like to do. So I should have a fib from here, which is that sort of COVID crash low. Take it up there if I really want to go back as far as I can. And then I'm looking to take some fibs from here, which I haven't done yet. But I think it's reasonable, because this was a consolidation phase throughout the whole of 2021, really, and it was only then that we took off. So I'm happy to take my fib from that level, which was when the sort of second phase of that bull market started. And then off we went. Now, with the Bank of Japan pushing the yen higher and the Aussie retreating a little bit anyway, we've got support down here, from that second set of fibs at the 23.6% fib at around 93.70. We've also got the 100-day moving average around there. Now we did overrun slightly. I've got this level on my report, obviously. Did I put it on the trade sheet? I don't think I did. I think I've done it today, actually. Where's my trade sheet? Trade ideas. Here we go. So can you see that? No, you can't. There. I've been compiling my trade ideas sheet already. Oh, you can't see it. I have. Okay, sorry. You couldn't see my. I'm guessing you couldn't see my trades that I was showing you then either, could you? From my FTMO account. There's me putting it in front of the screen, and I'm guessing you didn't see that. Okay, never mind. Well, anyway, you'll have to just believe me that I'm trading a real money account. So that's the big support level for the Aussie yen, 93.80, 93.70. We overran a little bit to 93.34. I think that's well within the margin of error, especially in these volatile conditions. So a break below 93.30 would not be good for the Aussie versus the yen. We've got a decent trend. Well, we have got a decent trend line here actually. That would be the next target, 92.60, if we do break 93.30, and then 92.18, which I don't really see as support. I see it as a target. I think there's more likely to be a bounce off 92.60 than 92.18, but ultimately we could get down to 91.00. By the time we get there, the 200-day moving average is going to be up there, isn't it? So that's going to be lending quite good support. We do have a spike low just below that at 90.50, so that's a decent level. So really, my levels for the Aussie yen are sort of 93.70, 93.50, break below 30 targets 92.60, break below there 92.20, but eventually we'll probably get to 91.00, and then we'd have to review it. By then we will be getting pretty oversold. We're just entering oversold territory. Is there anything on the weekly chart that I need to show you? No, not really. Oh, well, this trend line here. So that's the trend line from the whole of 2022. Why do I not have that on my daily chart? Why do I not have that on my daily chart, which is different? Oh, I see. I see what I've done there. What I've done is, hang on, I've completely confused myself. Why have I confused myself? That trend line isn't actually right, is it? That wasn't drawn right. Yeah, that needs to go there. Okay, sorry, I'm dithering. That's it for the Aussie yen. Any other yen pairs? Euro yen I should probably look at. And euro, considering the euro, there's a big trend line on the weekly chart. Yeah, I think that was one I was showing you. Okay, so the euro versus the, sorry, that's the euro versus the dollar. Euro yen, here we go, euro yen. Okay, euro weakening, obviously. I need to look at the weekly chart to get some perspective on this. I've forgotten what the euro yen chart looks like, so let me go right back to it on the weekly chart. This is a mess, actually. I've not been able to make much sense of the euro yen for quite a while, and I will admit to you that I can't make much sense of it now. Let's have a look. Is there any? There's no real pattern here. Yeah, look, there's no real pattern here. It's fib lines only for me. There's no real pattern. There's no real trend lines. I'm going to look at the monthly chart just to see if there's anything. Well, big candle there as we hit the 500-month moving average. I guess that's relevant. But yeah, do you know what? I can't make much sense of that. So it's not even a pair that I would actually trade. So unless anyone else has got some thoughts on that, I'll leave it. New Zealand dollar versus the Japanese yen. Weekly chart. This has actually been quite kind to us, hasn't it? Was this the one? No, it was a New Zealand dollar versus the CAD. Again, 200-day moving average doing its job as support there. So I guess if that breaks, we've got the low here at 82.09. You know what, this isn't really saying much to me either. This is just basically, look, for so many months, this has just been going sideways, and I can't really do much with that. Probably it's going to, if it breaks the 200-day moving average, well, of course, that's quite significant. But are there any big fib levels or trend lines or anything on this that I can actually sort of get excited about? Not really. Well, I don't even know why I've got that trend line. I'm going to take that off. No, do you know what? I'm going to leave it. Right. Are there any other yen pairs that you want me to look at? Let me think if there is anything that's worth looking at. JB, tell you what, let's have a look at the pound yen. I need to get into stock markets, because that's where all the fun is. But let's have a look at the pound yen. Oh, by the way, if you've paid for this session, I'm going to throw in reports for tomorrow. So I'll stick you on my email list that all my subscribers get. My subscribers are in here for free today anyway. But if you've paid for this, I'm going to give you all the reports for tomorrow, which is going to have all this analysis, all the levels in there anyway. So I just thought I'd throw that in for free for you guys. And you'll get my cheat sheet, which I can't show you because I don't know how to work this blinking software, but you'll get the cheat sheet as well, which my subscribers always get. Okay, so pound versus the yen is broken. Look at that. Pound got absolutely walloped. I mean, what is going on in the UK? Well, it's crazy. Thursday, the Bank of England puts interest rates up 0.5%. Okay, bang in line with everyone else. Not particularly aggressive, 0.5%, especially when you consider that I think inflation in the UK, is it 10%? 10 point something? It's a double-digit inflation in the UK. I feel sorry for all my fellow countrymen back home. It's a bloody mess there. It really is. And so the last thing that the country needs is higher mortgage rates, or the threat thereof. So after Thursday, Bank of England puts interest rates up, trying to just do everything steady Eddie, and then the Chancellor goes and cuts taxes. I mean, I just couldn't believe it. This is an insane period of time. I couldn't believe the mobilization in Russia. That was something that was just like, God, Russia actually going into the streets and taking people off the streets and saying, right, you're now going to be a soldier. I mean, my son's nearly 17. If that happened to him, I'd be absolutely distraught. And, I know Russian people, they're lovely people. They're having to deal with this. So that blew my mind. The Bank of England and, well, you know, the Chancellor of the Exchequer, I just can't get over that. I really can't get over it. It's like driving a car down the road, slamming on the brakes and slamming on the accelerator at the same time. It's just crazy. And of course, you know, the pound didn't like it. The pound's completely collapsed. Gilt yields are now through the roof. I think they're even talking about, or there's speculation from some investment banks that the Bank of England will go and have an emergency meeting next week and hike interest rates. Now, I haven't seen the Bank of England do an emergency interest rate hike since I traded on the life floor in the 1990s. And I remember when they did that, and I was out having breakfast, or it might have been a pint at lunchtime, and I absolutely tore up the escalator. I think by the time I got into the sterling option pit, I was already down £50,000. I was absolutely sick. So I thought of that this week when, you know, I think that was the last time the Bank of England did do an emergency rate rise. It would be fascinating if they do that next week. You know, literally, I don't think they've done that for 30 years. This is the kind of insane place we are in at the moment. That's just the UK. Then we've got the whole Russia thing, mobilising 300,000 troops. You know, the war is clearly, you know, not over and going to escalate. What is going to happen to energy in the winter? You know, Putin is clearly in fighting mode. Well, he's in survival mode now, isn't he? So what happens if he says that's it, no energy? I mean, anything can happen in this world right now. You know, it's just crazy. Right, back to the charts. So, pound has collapsed. Yeah, look, the pound's basically in free fall. I'll have a look. Did I look at that already? Yeah, I did. Oh, look. So the pound's probably, against the yen's probably going to 154.00, 153.50. I suppose in some ways, governments like the UK are doing some of the work for the Japanese, because the yen is clearly pushing higher against the pound anyway. Now, when you look at the pound versus the dollar, this is so ugly. It's getting to the stage now where I won't actually be able to write my report because we're going so close now to, and I'm kicking myself because I still have some pounds, which I don't need because I don't live in the UK. So it looks like, I don't see how we're going to avoid a retest of 105, which is the 1985 low. Absolutely crazy. 37 years. That was the last time we got to that price. And we're in free fall pretty much. I can't see how it's not going to happen unless the Bank of England does step in and do a 1% rise to try and stabilise the currency, because, of course, that's just importing inflation. Apparently there's another £6 on a gallon of petrol because oil, you know, we import our fuel. Or, you know, the UK imports the fuel. I'm not there anymore. Look at that. You know, the pound dumped, oh my gosh, the pound dumped 9 points last week, 900 pips, and closed almost bang on the low of the week. That doesn't look good. Who is going to be thinking, let's buy the pound on Monday morning? You know, no one's going to be thinking that. So I think we're going to 105. The only way I can really do it, again, is to do that thing with my fibs that I'm going to do. So I'm going to take the last major swing up. There you go. And then I'm going to look for the projection down. So, oh my God. If we break 105, could we, I can't even say it, could we go to 96.50? I mean, I don't know. That chart says we could. I'm going to leave that with you. That chart says we could, but then, you know, if I'd have said to you here, do you think we could drop from 121 to 108 in a month? We wouldn't really have thought so, could we? So can we drop from 108 to 105? Yes. Can we drop from 105? Can we drop another 15 or 14, 13 and a half points, pips? 30, 100, anyway, whatever. Crazy. Okay, just bear that in mind if you're trading cable and you want to know where we could actually go to if things really, really get messy. I mean, I think the Bank of England would have to step in and do something to stabilise the pound then. You just can't, that would be so inflationary. It would just be off the scale crazy. All those imports just going through the roof. I dread to think what state the country will be in if we start breaking below 105. Right, shall I keep talking? Right, let's get onto the stock markets. Let's get on. Oh, this is worth looking at. Now, the pound Swiss. I had this for us as a buy opportunity. It didn't work at all. It did at first, but it didn't work at all in the end. Now look, we've broken this trend line. a big trend line going back to, again, to what's that? Okay, 2015, real nice trend line during 2020, and I thought, okay, we could actually bounce off there. This is a nice big triangle. Maybe we can bounce off there. Maybe there is hope for the pound. But of course, after this week, there isn't. And I wonder where this is going. Pound versus the Swiss. I don't know. Could we go to 99.00? Yeah, why not? 16 pips away. 1,600 pips away. I guess we could. Right. Here's the exciting stuff. The stock markets. I'm going to actually start with Europe. Let's do that. Not as exciting, but we've definitely got breakdowns. So this is the DAX. How the DAX is holding up, I really don't know. It looks like Germany is in such a hideous mess. But maybe it must be the weak euro that's helping sustain some of the DAX index. Right, I need to put a trend line on here. There we go. So we've broken there. I could probably get rid of that trend line. Right, the DAX is clearly in a bear trend for this year. No surprises there. Now, I could call this one big triangle, couldn't I? I think that's fair enough. Markets have been mostly trading flat, which is pretty remarkable, really. I mean, we have been edging lower, but now it looks like we're breaking the lower trend line of the triangle pattern, which of course is not good. A descending triangle is a bearish pattern anyway. It of course indicates that sellers are willing to accept lower and lower prices on every bounce because they want to get out, or they want to get short, or they want to, exit their positions or their investments. And now you want, and therefore once you break the lower trend line, and we've only just broken it. We've only just broken the previous lows, and these were good lows. We had a real strong bounce off here, off 12,367. Two strong bounces off there in the summer, so that really did work well. I don't really know why it worked as such a good support level actually, but it did, and then we bounced to the trend line. Now we're breaking it. As I said in the Telegram group on Friday, 12,350, 12,400 could hold the bounce, and I think we hit 12,350 and just turned around. So technically speaking, actually let's look at the hourly chart. Technically speaking, the levels are working still as the market panics. What is going on with that chart? So where's my little bounce to 350? This is the hourly chart. There we go. We got to 12,351. I actually managed to sell it there. So actually, for once, did what I said we should do and sold it. Oh, we had quite a bounce back on Friday, right into the close. It's quite resilient, this market, isn't it? But I think it's got to go down. I know the bund yields are through the roof, which is interesting. Okay, so the daily chart only showing us really that we're breaking down. I mean, even the break below this trend line, I think, was quite significant. Certainly, it acted as resistance. Can you see that? We had this little trend line here, just joining the 2nd July low to the August low, and this did hold initially, at least on a closing basis on the daily chart, but then we broke lower, closed below it, and of course acted as a nice little bit of resistance there. That 12,650, 12,700 level, if you followed me on the DAX, you know that I had that as a level. That was why I did. They'll be broken lower. Now my level is 12,350, 12,400. Holding below there should see the market collapse. We're only just entering oversold territory on the daily chart, so no reason to buy it from that perspective. Oh, by the way, love Twitter. So I've seen things on Twitter, people saying, well, the market is at a record oversold levels. I don't know by what measure, but we've never been so oversold. Okay, brilliant. It doesn't matter. That works when you're in a bull trend, and the stock market has been in a bull trend for a hell of a long time, because every time we've gone down, it's only been a correction. Like that COVID crash was just a correction in a bull trend, because of course government cut rates, threw money at the market because they could, and they're absolutely determined to sustain the bull market. So people that have only seen a bull market, and that's basically everyone, because that's all we've ever been in. I mean, I've only ever seen a bull market, and I'm a bloody dinosaur. But when markets are no longer in bull markets, and in particularly when they're in bear markets, being oversold means absolutely bugger all. It doesn't mean anything, and it's not a good idea to be buying into the market. Look, it'll be the reverse of this. So we're in a bull market, and when you're in a bull market, you get overbought real quick. On the first leg up, you get overbought, and then you dither around a bit, and then when you really gain the momentum, you just stay overbought. And nobody sells it when we're overbought, because you know damn well we're in a bull market, and it's going to be like that now that we're in a bear market and in what I think are going to be crash conditions. This market is already going to is probably already oversold. Well, the S&P is probably already oversold, and it will stay oversold, and it will just, and the markets will just keep dumping. So that was one of the things I saw on Twitter about, we're oversold, so the market has to bounce. That will be interesting to see if we do on Monday. The other one was, we're at maximum pessimism. Okay, so yes, when you're in a bull market and you're at maximum pessimism, as you probably were on the COVID crash, maybe 2008, 2009, the housing crash or whatever the hell it was, global financial crisis, when Lehman's went bust. Was that when Lehman's went bust? Oh no, that was 2003. No, that was 2008. Sorry. What was I going to say? When you see maximum pessimism in those situations, okay, fair enough. Maybe that is the bottom of the market when you've already fallen significantly, because the government can step in and they can do the QE and the blah de blah. But maximum pessimism is no good to anybody when the markets panic and volume dries up. There's no liquidity. Everyone is too scared, and that will be the next stage of this, as I've said to you right at the beginning. You know, when Cathie Wood has decided to stop buying the dip because she's realised she's wrong, she's already had to resign from 2 of her funds. Then when she stops buying, and people like her, who's that other idiot? Tom Lee, love Tom Lee. If you follow me on Twitter, I love having a dig at him. The eternal bull, who in July of this year said that we're going to be retesting the year's highs or maybe breaking above them. Yeah, well done, mate. Okay, so DAX is breaking lower. What do we need to do next for it to convince me that we're going down? Let me just pan out. Okay, this goes back to the global financial crisis crash low of 3,588. So then I put a second set of fibs on from the COVID crash low. Now we've got a 50% fib here at 12,120. So we break below 12,120. That's probably going to confirm that we've broken that trend line, the lower trend line of the triangle, and we're headed towards the weekly or the 500-week moving average at 11,750. It's probably going to be 11,800 to 11,750. That is my real target in the DAX. That's where I think we're going. Let's have a look at the monthly. Sorry, LMK2. I don't know what that means. That's isn't it? Hi, right, okay. Oh, this is interesting. The 100-month moving average is being tested now. Again, I didn't know that. Naughty boy. I didn't look at my monthly chart, which is why you have to, because this is really important. So just watch that on the DAX. Look, maybe that will hold. Maybe I'm wrong. Maybe we won't crash. Maybe we'll bounce off that, and the crash will be delayed, or maybe we won't get a crash at all. But so there you go. That's going to be really important. 12,100 or 12,200 down to 12,100 is now absolutely, really, really important in the DAX. You break below 12,000 and it is good night. We are going to 12,000. We're going to 11,500 to 11,400 probably real quick. And the problem is if you start getting momentum to the downside, then you get panic and blah, blah, blah. It's going to get really messy. As I say, liquidity drying up. Then you start vacuuming through these prices. But just watch 12,000. Okay. FTSE is all over the place, and I'm not really too clear on that, if I am honest. But let's give it a go. Let's at least look at the monthly chart to start with. So I think the DAX and the FTSE have been held up quite well because of the weak pound and the weak euro, I'm guessing. Yeah, look, this is just erratic, isn't it? This is just one big sideways trend. You wouldn't really know that the world's in a mess and that the UK is in a hideous mess by looking at the FTSE chart, to be fair. So I assume it's being held up by the weak pound. How did we do on Friday? Yeah, we did dump. Bond yields, the problem is gilt yields went through the roof, which is going to, make people shit themselves. And with talk of base rates going to 5.5 or whatever it was with that crazy Chancellor fella. Okay. So we're testing we are really testing some big levels here. 500-day moving average in the FTSE. So that was a good level. That 23.6% fib was a great level. That trend line worked really well as well. So technically it was doing quite well. But Friday, basically the floodgates opened, the floodgates for the sellers at least, and we've gone straight to the 500-day moving average. So that's going to be key. Watch this next week. 500-day moving average at 7,000 in the FTSE, and then that 12,000, well, that 12,100 level is actually the level in the DAX. Break below 12,000, there's your sell signal. Can I tell you how to enter at what point is safe for the DAX? Okay, let's go back to the DAX. Right, to enter a long position, look, it might be worth it. And when you look at the US markets, it might be worth it. But I think that on this is what I'm thinking. If I was a hedge fund or responsible for someone else's money and I've been short, and there are a lot of shorts out there. So you're short, you've had a good week, you've capitalized on some panic on Friday. You probably your boss is going to say, listen, let's just take some chips off the table for the weekend. You don't know what might happen, just in case Powell says, oh, I don't know, just in case there were some bullish noises somewhere. I know that a boss somewhere is going to tap someone on the shoulder and go, look, you've had a good week. We've run this short really nicely. We've done well over the last couple of weeks. Why don't you take some off? And then you can always sell it again on Monday on the open. I think this is what might have happened on Friday. Into the close, take some profit in your DAX shorts or in your FTSE shorts, just as we approach the whatever it is, the 100-month moving average in the DAX and the 500-day moving in the FTSE, a moving average in the FTSE. And there's some levels in the US markets as well. So, yeah, I would suggest that some of the big traders would have taken off some of their short positions, cut them by, I don't know, whatever, 20, 25%, 50%, I don't know. And maybe that's what happened. And they're thinking, right, if nothing bullish happens over the weekend, if something does happen, then I can sell it again on the bounce, happy days. And if not, I can just get in there on the Sunday night and the Monday morning and just start selling out again. I don't mind giving up 2% for a weekend in which I can have a good sleep and relax and be ready to go on Monday morning. I don't mind giving up 2, even 3% if that's the case, because I know that the next move down is probably going to be 10%. And as long as I catch that, I'm happy. So this is what I'm thinking might have happened over the weekend. So if we start gapping lower on Sunday night, Monday morning, like if we get an opening gap to the downside, it shows you that there are some aggressive sellers out there. And I think those aggressive sellers would be the guys that took the profit on the Friday, ready to get back into the short on the Monday. We'll see. Don't know. Just me guessing. So yeah, watch for the gap. A gap lower would be a breakaway gap, and if you know what a breakaway gap is, it just shows that there's aggressive selling right on the open. Nobody wants to hang around to see if there's going to be a bounce. They just want to get short. So that might be people selling into short positions that got out of those of some of them on the Friday, or it might be people that over the weekend have gone, Jesus, I've run this far enough. I'm long. I'm wrong. I need to get out. This is starting to look bad. Look at the bond yields. Look at the dollar. Look at blah de blah. So watch for that. Okay, so sorry. The question was how to enter what point in the safe for the DAX. Okay, to buy into the DAX I'm not going to do this myself. I don't fancy it myself, but it may be worth buying at around 12,200, 12,100. Where did we get to? We got to 12,200. So we know that that's a support level, and we know that a break below 12,000 should be a sell signal. So look, if you want a low risk trade, it could be worth buying it at like 12,150 and put in a stop at 11,980. If you don't mind risking that, as long as you're going to be quick to reverse into a short position, because if we break 12,000, I think we're going down to, what did I say? 11,500. So that could work. Now, if we do bounce, then it's really just a case of throwing some fib levels on an hourly chart to find out where we can go. Talking to fib levels, I'm going to put them on the Dow on the daily chart and see where we might go. Is that the full move? No, it's not, is it? Need to get the full move. So I'm just going to break. This is how I would be looking for a target on the bounce for the DAX. Take the whole move from. Is that the whole move? No, it isn't, is it? What am I doing? Okay. Do you know what? I am going to be silly and do the whole thing. That should be from January, shouldn't it? Yeah, there's January. So that's the whole move. And I am going to be disciplined and do this because I do want to just break down all the levels. Just say, for example, I did think that the DAX had hit a low for the correction. And I was trying to figure out what happens next. Where do we go? Do I buy into a long? Why? Come on. Why won't you pinpoint? Okay, I can't seem to get this to go where I want it to go. But that'll do for now. Now, look. This often works, and I know that you've seen me do this before. This is what I like to do. take the whole move, put the fibs on, then go to the 61.8 and take that and project that down. Oh, that has worked. Has it? Come on. Okay, for some reason I can't get to the actual low. Okay, then that gives me my secondary set of fibs, which I do like to do. Then I have to take another set of fibs. Now I am going to take them from that swing high there because it is so it is such an important swing high. Then I've got my sort of row map of fib levels. The second set of fib levels I would then take from this peak because it's around moving averages. It was the last decent swing high. It kind of matches up with the 38.2% fib. So I'll take that, and that'll just give me some minor fib levels down. No, it won't. It's now stuck to the 100-day moving average. I'll just have to take it from there. There we go. Oh. Right, I'll take that, put that down there. That'll do. Right, so my first level would be 12,375, which is already acting as a resistance level. So that, as you know, so if you fancy the stock markets to bounce, if you're in that camp, and they could, then you want to be buying at around 12,200, 12,100, stop below 12,000. Your first target is 12,350. If we keep going, then you could be looking at 12,550 up to 12,600. I would be taking profit there. That is a big level because it's previous swing lows. There's a lot of moving averages on the hourly chart there. That would be a real good short. I don't think we're going to see that level, but if we do, I think 12, yeah, I'm going to call it 12. Yeah, 12,550, 12,650. That's going to be a big resistance level. So if you, I would be getting short there for sure. But the problem is I'll have been squeezed out of some shorts by then anyway. So those are your levels for the DAX. 12,350, 12,400, 12,650, sorry, 12,550, 12,650. Break below 12,000 is your sell signal. I hope that answers your question. If not, please let me know. And then a break below 12,000, we're going to 11,750, I think. Probably quite quickly. Right, US stock markets. Before I need a drink of water. Okay, this is the fun stuff. I've saved the best till last, I think. Right, we had a head and shoulders pattern in the S&P. This might take me about half an hour, but it should be worth it. We had a head and shoulders pattern. Oh, come on, don't freeze on me now. Right, we had a head and shoulders pattern. Now, you'll know that I called the top of the market in January. And it was purely because of this December-January head and shoulders pattern. It looked fairly obvious to me. Probably not the only person. It's basic technical analysis. So we had left shoulder here, or maybe that was the left shoulder, I wasn't sure. Then we had the head. Then we had the right shoulder. The neckline was just beautiful. And it coincided with the 100-day moving average. And I thought, right, if we break that, then we're going to start something of a bear trend. So, yeah, as I say, fairly basic. You know, we dipped below the 100-day moving average before, but we hadn't really seen anything significant below the 100-day moving average since the COVID crash. And there wasn't anything specific that was causing the FTSE to the S&P to roll over, such as COVID or housing crash or whatever. It was just talk of higher rates. So that was my first sell signal. That worked really well. We got down to my first target and we bounced. The bounce was just beautiful. 100-day moving average. It was probably a fib level, was it? Can't really remember that far back. Yeah, it was. It was. Can you see that? It was. I'll take that off. It was the 61.8% fib at 45.80. It was the 100-day moving average. And we'd already completed the head and shoulders pattern. It was actually the 50-day as well. So that was an obvious sell. I can't remember, but I must have been getting a short there. Does anyone remember that? I'm sure I got a short there because I was already in bear mode anyway. And then we dumped. Actually, I'm just going to take that off. There we go. And then we dumped. And now we have a trend line because of that dump. Actually, this would have fooled me. I'm not going to lie. That would have fooled me because I was definitely thinking we're in bear trend mode there. So I don't know what happened there, but I'm guessing that would have fooled me and we'd have lost money. Then we dumped a little bit and went up, and then we got the 200 and the 100 acting as resistance, which is as it should be. And we've got a moving average crossover. Now this doesn't happen often. 100-day moving average crossing below the 200-day moving average. So that was pretty negative in April. Anyway, then we started to accelerate to the downside, which is not really a surprise, is it? Once we had the moving average crossover, once we'd failed to get back above the moving averages on the second try, bang, down we went. 500-day moving average, the obvious target. That did a rubbish job of holding it. We moved. This was a confusing part for me as well. Not going to lie, there are times when I get very confused. Didn't know what was going on there. Anyway, then we dumped. Now, the June low, which I did pick, was not because there was anything on the S&P chart. The reason I said that we'd probably bottomed was because of the Nasdaq and the DAX and the Dow Jones, and I'll show you that in a minute. Anyway, now this bounce, I will admit, was further than I expected. I thought we'd probably stop here at the 38.2, which is where the 500-day and the 100-day moving average, we were just getting a crossover there, but that's where they were. I mean, that was a big resistance level, so I was really quite surprised that we broke above it. I wasn't surprised that we got to it necessarily, but I was surprised that we broke above it. Then we had the trend line, and then we had the 200-day moving average, which is just below the 61.8% fib. So that was not a surprise. I'll remember that price forever, 43.25. I'll remember it because I had it at 43.35, 43.45, because I was trying to be clever and pick a zone in between the 200-day moving average, the trend line, and the 61.8, which I still thought was important. I thought with the amount of momentum we've got here, we're probably going to have to kiss that, turn around and dump. Now, the first day, we didn't. We didn't get to 43.35. We got to 43.27. So by the next day, I thought, oh, shit, we're not going to do it. And we're just going to turn around and dump. So I had 43.25, 43.45. Now, I know some of you just saw me say that it's going to, this is a big resistance level. I know some of you sold it. And some of you have even shown me your P&Ls from it. So well done. Hands up, I didn't do it. I seem to miss more of my trades than anybody else. But that's because I'm always distracted with something else. And then we turned around. And then look, 500-day moving average did a good job. Then we broke it. Then the 500-day moving average, the green line, acted as resistance. I mean, these moving averages are really good. You've got to keep an eye on them. Just so you know, I look at the 50, the 100, the 200, and the 500, and I look at them on all time frames. So that's monthly, weekly, daily, 4 hour, 1 hour. I don't go any shorter term than the 1 hour. Right, now, we dumped. I identified this as a big bear flag, you might remember. I know I posted it in the Telegram group. I said, this is probably a big bear flag. We'll probably break down eventually, and we did. And we even got a retest. How nice the market is. It often gives us a retest. My throat's going to give up in about 25 minutes, so that's about as long as I'm going to last. That'll be 2 hours. Got the retest, down we went. Now, what am I thinking? The Powell thing. That gave us a retest of something as well, didn't it? 39.00. That wasn't the Fed meeting, was it? I think it was. Oh, anyway. No, the Fed meeting was on Wednesday. Yeah, that's right. 39.00, 39.20 was my big level, wasn't it? That was partly to do with the fib level, partly to do with the trend line of the bear flag that I had. So on the Fed meeting, when they hiked rates 0.75%, initially the market dumped as expected, and then kindly rallied up to 39.00, 39.20, ran as far as 39.25 maybe, I don't know, and then the market collapsed. So it gave us a chance to get into the short positions beauty, which hopefully you did along with me. And down we went. Right, now, more importantly, that's my little history lesson for you for the S&P. Does anyone want me to show you the head and shoulders pattern for 2008, 2009? If you do, just tell me. If you've seen it, I won't waste your time. Now, we've broken below. Now, the reason this bounced here, I'll show you in a minute, is because of the Nasdaq and the Dow. It's not because of the S&P. Now, I think we're going to break that, although we just held it on Friday. But we didn't get much of a bounce. 200-week moving average is the one we've got to look at now. 35.85. I think that's where we're going. Probably hold it, but I don't think we'll hold it forever. I can't really put my finger on anything else. And we're just entering oversold territory, so I wouldn't be, that's not making me feel bullish. Markets pushed up during the Powell speech before collapsing. Yeah, that's right. And do you know what? I saw someone on Twitter who predicted it. He said, this is interesting. He said in the last 3 Fed meetings, when the Fed have raised rates, the stock market's dumped initially, then they bounced back to the levels that they were, and then they collapsed. And it did it for the 4th time. Amazing. Right. If we look at the hourly chart, there is actually quite a bullish candle. Is it a bullish engulfing? No, not quite, because we didn't make a new low. But we got a decent bounce back. There you can see that the green candle on the hourly chart. I'm not thinking that this is. I don't think we're going to get a double bottom low. I might be wrong, and I might really have egg on my face, and I might have a hole in my account as well because I'm still short. So that's going to panic me if I'm wrong. But I just don't think that this is the beginning of a bull run. Anyway, there's your fib levels. 37.30, 37.70, 37.80 would be the first two resistance levels from that. There's my first set of fibs, really. 38.00. Okay, I'm not going to pay too much attention to that because I don't think they are. On the daily S&P, do you see a possible cup and handle? Are you talking about a reversal cup and handle? Or are you talking about the right way up? Because I don't see one the right way up. No, that's not a cup and handle if that's what you mean. But if you're talking about a reverse cup and handle, which, yeah, inverted, okay, that's pretty clever. Yeah, well spotted. I do. And I'm not very good at spotting those things, but I think you could well be right. And I know what you're saying here. You're saying that this is the cup, aren't you? That whole rounding thing, and this is the handle. Yeah, okay. And basically what you're saying is if we break this low at 36.39, it's good night S&P. We're going to do another. Is this correct? You'll have to help me with this because I don't know the pattern very well. That means we're going to drop the whole base of the cup. Is that right? So that means we're going to drop another 100 and whatever it is. Sorry. We're going to drop another 1,170 points. Is that correct? Is that right? If we do, that is nasty, and I wouldn't rule it out. So if I'm right, I'm waiting for your reply. If I'm right, and I'm just going to call it 1,100 because I'm not very good at maths. That means we would be dropping to sort of 2,500, wouldn't it? Is that right? Oh no, from the low in June to now. Okay. Oh, okay. You're talking about we just dropped the handle. Is that right? So is the projection of the handle, or is the projection of the cup the measured target? Sorry, I should know this. I've only been a technical analyst for 15 years, and I don't even know what the projection is of the cup and handle. But either way, if it's just the handle, then we're looking at 650 points. So even that takes us down to 3,000. That alone is pretty scary, and I do think we'll probably go there. If anyone knows the measure target for a cup and handle, otherwise I could quickly look it up, I suppose. So you're saying that the target is 3,000 down to 2,700. Okay. Right. So I think we're going to. We just formed the inverted cup. Okay. So someone not the handle. Right. We have to break the June low, don't we, to complete the handle? Is that right? Okay. Oh, it's the cup. Well done, Jonathan. It is the cup. Fucking hell. Excuse my language. I don't like to swear on YouTube, but that means we're dropping 1,200 points or something in that region from 36,000. So that means we're going to 2.5. Now, that's interesting. Very interesting, because I was looking at this as a target. This is a realistic target. And look, okay, this is a really realistic. First of all, the first realistic target is a 200-day moving average, and I think we're going there anyway. That's 3,600. Okay, that's got to be done. We've got to test a 200-week moving average. Now, look at this. Even if, right, the 50% fib from the COVID crash low is call it 3,500, so just below the 200-week moving average. Now that doesn't even take us as far as the peak before the COVID crash. Now that was at 3,400. Now I remember thinking 3,400, blimey, can't believe we're here. It's just crazy. This stock market is so overpriced and blah de blah. And we haven't even dropped to there yet. I mean, did anyone else think at 3,400 that we looked crazy expensive? How much further can we go? You know, and of course then we crashed to 2,174. So it's only 2 years ago, 2 and a bit years ago, that we were at 3,400 and it seemed high. We're nowhere near that now. We're 300 points away. So even if we just got there, we've still got 300 points to drop. So to get to 3,200, I think is very, very doable. Very doable. And that's only the 38.2% fib. And it's only a 61.8% retracement from the COVID crash low to the all-time high. So that is a very important level. 3220, 3180 is an important level. I wouldn't be at all surprised to see that. You're talking about what? 10%? Is that another 10%? No, it's 15%, isn't it? Is that right? 15%? Why is my maths not better? I did do it for O level. So 3,200 looks like we're probably going. Now look, if that cup and handle, Jonathan says it's the depth of the cup that's the projection. That's going to take us to the 500-day moving average. It's also going to take us to the 50% fib. It's only going to take us halfway through the COVID crash low. Historically, it's not that big a deal. 2750. We could easily go there. Then all we've done is retrace 50% of the whole move from the global financial crisis. And considering the mess that the economy is in, that complete and utter mess that we've got ourselves in from the US public debt, I believe, is 100% of GDP, which has not happened since the end of the Second World War. Obviously, they borrowed like crazy in the Second World War. There was a reason. Yeah, you're talking about the daily chart. Sorry, I'm looking at the weekly chart. But, it's the same pattern, obviously. You're talking about this on the daily chart, yeah? The inverted cup and handle. And I think you're right. So, yeah, the debt levels, we all know. We all read the papers, just off the scale. So, for the market to only drop 50% of the last 13-year bull run, it's not much, is it? It's not much at all. If we take it from... Right, now I'm going to get really boring on you. I can't get really boring on you. I'd have to go onto the SPX. Okay, that's the lowest point I can go back to. Yeah, I was thinking about if I went back to the year 2000 or something like that. But doesn't really matter. The year 2000 would probably only be the 38.2% fib of the move from the year 2000. If you want me to look at that, I will, but I don't want to bore you. Senseless. Okay, let's move on to the Nasdaq. So look, 3,200, I think 3,600 is where I feel confident we will go, probably next week. 3,200 is definitely a realistic target, and 2,700 could be seen. We will see. Now, there's nothing on the S&P chart for me to think that we're going to bounce, and I'm short the S&P. For the Nasdaq, there are some levels that we're hitting. No, you're looking at shorter term inverted cup and handle, starting from the low of June. I am so sorry. Okay. Starting from the low of June. Right, why did I not see that? Let me go back because this is important. I do want to see it. Starting from the low of June. Inverted cup and handle. Are you talking about this? Are you talking about the June low to the August high to the early September low? I'm slightly confused, sorry. From the low of June to today. Oh, I see. So are you talking about this being the cup? But we haven't formed the handle yet. That's what you're saying, isn't it? We just formed the inverted cup. Okay, so what you're saying is we've just formed the inverted cup. We need to now bounce to maybe 3,900 to form the handle, and then we'll have a projection from 33 down to 36, call it. 43 down to 36, which would be roughly 700 points. Yeah, no handle yet, the cup is only formed. Okay, I get you. Okay, yeah, possibly, but you're jumping the gun there because I don't know if we're going to bounce. But if we do, then that's worth watching out for. Yeah, good suggestion. That could be the cup. That could be the handle if we jump to 3,900 and then turn around. But actually, I think what you may have spotted, and tell me, because you're probably more of a cup and handle expert than I am, but could I argue that this is a cup and handle in? Could I argue that the cup is the whole rally up, then the rounding up until the June low, and then this is the handle that we've just formed on the bounce to 4,300. So you're saying that could be a cup and handle. So that's pretty damn serious then. If that is the case, and we break 3,600, then 2,500 is actually a realistic target. So that's pretty scary, isn't it? But it would fit in with what I'm seeing on my charts. I think that is a very realistic target. So thank you for that. That is very helpful. Right. I'm actually seeing quite a lot for myself. I need to do these every week. I'm seeing stuff that I wouldn't have otherwise seen. Okay. Now, Nasdaq. Right. The reason we bounced initially from this point, well, we'd gone so far anyway. We were heading towards the 200-week moving average and the 38.2% fib. Guys, you'll remember that, won't you, from back there, my reports and stuff. And we bounced at 11,035. Right, very strong bounce up to the 100-week moving average. Now look, we're about to get a 100-week. The handle shouldn't be more than 50% of the cup to validate. Ooh, let me go back. Because this could be a cup and handle too. Now, if this is a cup and handle, oh, I'm getting all cup and handle now. Look, getting all excited. So that definitely isn't 50% of the retreat. You're saying, Angela, that we should not go more than 50%, yeah, on this bounce. Okay, so if that's what you're saying, this is the 50% line, 13,900, which is bang on the 100-week moving average. So we didn't go more than 50%. So in that case, this is a valid cup and handle, which I hadn't even spotted. You guys are doing a better job than me. Shouldn't. Okay, so it didn't go further than 50%, so therefore it is a valid. And the fact that we hit the 100-week moving average was nice. We've now got a potential moving average crossover. The 50 is just about to cross below the 100-week moving average on the Nasdaq, so that's just starting to be a sell signal. And anyway, the 200-week moving average is clearly the one to watch. Now, if we break that, it's going to be pretty nasty for the Nasdaq. The next thing is we break 10,700, and that would be pretty nasty for the Nasdaq. And I think it's probably coming. Look, we're clearly in a bear trend. Let's just have a look. We've got moving average crossovers here. Yeah, I wanted to point that out to you. So we've got the 200-day moving average now crossing below the 500. We've got the 100 already crossed below the 500. The 50 just crossed above the 100, but don't pay too much attention to that. If you want to project some downside targets, again, we can do that Fibonacci thing where we take that low, take this high. So look, just on that last counter trend correction, we could be going to 9,387. Where does that take us on the weekly chart? 9,387. Bang, bang, bang. 9,387. Okay, that's kind of no man's land here. Oh, hang on. What's this? This is the COVID crash peak, 9,763. So we could certainly be going to 9,763. Anyway, I think if we break the 200-week moving average, if we break sort of 11,000, it's good night for the Nasdaq. We're not even oversold on the weekly chart. Getting oversold on the daily chart. Actually, there's not really much I can say about that, other than you've probably well, look, if this is a cup and handle, and it probably is, if we break 11,000, geez, I'm going to have to do some homework on the old cup and handle, aren't I? That will take us down 6,700 points. Ooh, oh my word. No, it won't. 5,700. I'm so crap at maths. 5,700. Okay, so that takes us to, can't really take us to 5,000, can it? Can it take us to 5,000? Well, I don't know. If that is the measured target, that is a bit tasty, but look, the 500-week moving average is at sort of 73.50, and that is just above the 61.8% fib. I've taken that again from the 2000 crash low. 70.70. You know, we could be looking at the low 7,000 region. It seems crazy, doesn't it? But then look, if I said Bitcoin was going to go from 16,000 to 30,000, 70,000 to 30,000, everyone would have thought I was an absolute nutcase. But I did, well, I didn't quite project that, but I did project Bitcoin to crash, didn't I? So look, that's realistic. Take that as you will, but certainly 9,750 looks reasonable. if we break the 200-week moving average, and if we break the 38.2% fib at 10,700. Okay, you know, it's not like there isn't any fundamental reason, is there? The Fed is, I don't think the Fed has ever engineered a soft landing. The only thing really is holding up the U.S. economy now is employment, isn't it? We're still seeing jobs created. But what happens, you know, with that FedEx thing? If FedEx stock has dropped 50%, and they say that the world is going into a global recession. I mean, surely FedEx, of all people, know, you know, have their finger on the pulse as far as the economy is concerned. Right, the Dow Jones is a tasty little chart and makes a lot more sense. So the COVID, the peak before the COVID crash was at 29,500, I'm going to call it. So that is also the 23.6% fib, because that's at 29,600. Again, taking that from the 2009 low. Okay, so there's some real big levels here. So the S&P isn't clear at all. The Nasdaq is fairly clear, but the Dow is very clear. 29,700, 29,500 is the level to watch in the Dow Jones. It's the 23.6% fib. It's the COVID high. It is the 2021 swing low. It's the 2022 was the previous swing low for 2022. There is a lot going on there. 200-week moving average as well, just in case you wanted something else to back it up. Now, we tested it. We actually broke. We got to 29,300. Now, by the time we closed, we were at 29,678. So we bounced back to the exact 38.2% fib. So place your bets, ladies and gentlemen. Do we hold below 29,700 and crash to 27,500? Do we crash another 2,000 points probably next week? Or was that a fake to get some shorts out and then we bounce? So you know what I think. I think we're gonna dump and crash. But look, the whole point of this, of me showing you, is yes, we are at some absolutely crucial levels in the US stock markets. Long-term moving averages, Fibonacci levels, previous swing highs and lows, and we've got those tasty little cup and handle thingies to watch now. So if we do break lower, you know, we're probably in one of those situations where liquidity just totally dries up, vol goes through the roof, we're all over the place, and we vacuum. You know, we vacuum. We don't even trade some of the prices on the way down. Yeah, what can I add to? I just, you know, all I can do is highlight to you what absolutely crucial levels that we are at. We probably haven't been at more crucial levels this year. I mean, that was fairly crucial, I guess. But this really is big, really big. And if it gives way, I mean, how, you know, if you were with me on 23,000, yeah, look, we could. There is the 500-week moving average down there at 23,000. So I'm guessing that's probably another cup and handle. I'm just going to quickly do the maths. If that is a cup and handle, we're looking at 36. I'm going to call it 36,900 down to 29,600. So what is that? That's 7,000 points. So we're going to drop to 22,000. Oh yeah, look, that's bang on. That is bang on. If that cup and handle actually plays out, we could be going to the 500-week moving average at 23,000. Where is that as far as my little fibs are concerned? I always have to check my fibs because they do just give me... That's not even 50% correction. Not even. It's nowhere near the COVID crash low. It's about halfway down the COVID crash low. So this, you know, that's perfectly reasonable. Yeah, things could go from orderly to disorderly. Oh, definitely. You know, there's going to... Look, one thing I know for sure. Longs must have stops in the low 29,000 area, because anyone who can read a chart knows that if you break the sort of mid 29,000 area, you're in trouble. So someone must have some stops in the low 29,000 area. And you saw, you know, Friday was a great example. If you were with me trading that gold from the Telegram group, I said the gold low is 1653. We start breaking 50, we're going to hit stops. We trickled down to something like 49. We trickled up again to 53. And as soon as we broke 50, bang, we were at 39 in a heartbeat. There were stops there. Then we got that little bounce to 1650, 1655 for the sell opportunity. So there are going to be stops there, and it's going to be really nasty. Look at the left low volume green handle. Low volume green handle. Oh my, what? Sorry, I don't know what I'm looking at. Am I looking at the weekly chart on the daily? Once balancing out. Okay. Oh, you're talking about this area? I'm not really sure what you're talking about. Are you talking about this one? But anyway, look, yeah, there are a lot of arguments for us to hit those targets, and I don't need to repeat that the fundamental situation for the global economy is a bloody mess. I think it was something like 24 banks. Am I right? 1 or 2 banks, global, central banks that hiked rates last week. Sweden, was it Sweden or Switzerland, hiked 75 basis points. Yeah, and that didn't even hit the news. I mean, that's an enormous rate hike. So it's not just the US that is hiking rates. And we've got a lot of central banks meeting this week. So I would assume they're all going to follow suit and hike rates. This is a real global problem. I was one of the first to spot the double top in gold. Was I? Oh, I thought everyone would have seen that. I thought it was so bloody obvious. Well, look, I'm going to finish up because that'll be 2 hours, but I'm going to show you how things can work out. And I'm going to, can I? I am going to try and get the data going back to 2008, 2009. No, hang on, give me a sec. I think I can do it. This is how things can play out so easily. I'm going to show you that head and shoulders pattern. Right, this is the story. You probably heard it. Sorry if I'm repeating myself. So it was 2008, which was 14 years ago. So I was 40 years old. I just started doing technical analysis. I just managed to get some bank clients. Oh, you were referring to the US 30. Gotcha. SPX. I was just, here we go. So yeah, it's 2008. I just started my technical analysis business. I'd read all the books, I knew all the theory, but I had no experience whatsoever. Anyway, there's me, Deutsche Bank, Morgan Stanley, Merrill Lynch, people like that. Bank of America were my clients. I didn't really have any retail clients. It wasn't a big thing at the time. Social media was only starting out. I didn't really know anything about it. I'm still fairly crap at it, let's face it. Now, what's this? So I'm reading these books and doing all this, and I'm thinking, hang on a second, we were aware that there was a housing bubble. I'd read all the books, and I'm seeing this, and I'm seeing, now this is not too dissimilar to what I just showed you at the beginning of this year. Look, this is 2008. This is the whole of 2008. This section here. Right, it doesn't look much because it's on a weekly chart, but it took a year to build this head and shoulders pattern. That's a long time. So big shoulder, head, right shoulder. There's your neckline. So let's pretend we're sitting in 2008. We're seeing that. I'm thinking, bloody hell, that looks like a big head and shoulders to me. And we've just broken the 100-day moving average. Remember how I showed you that we broke the 100-day moving average in January of this year? Okay. Then we revisited the 100-day moving average and actually poked above it. Oh, look. That's exactly what we saw in January of this year for the S&P. Right. Now, on the daily chart, I think, not the weekly chart, but still, similar pattern. And then, of course, we trickled down, hit the 500-day week moving average, bounced the 200-week moving average. That acted as resistance when it had been at support, tested the 500, and then boom, it was game over. That was when the Lehman's thing hit. Now, when the Lehman's broke, it was all, oh my God, Lehman's caused the global financial crisis. No, it didn't, because we'd already dropped from 1575 to, let's say, 1200. So we'd already dropped 300 points or 20%, which I think is roughly what we've done now. I think we've dropped about 20%. I need to go back to it. So we could be here. We could be here, and this could be what lies ahead. All the way down to 666, wasn't it, if I remember correctly, the number of the beast. So, that is where we are now, and then it looks like we've already gone down a lot. And some people are saying, oh, we've already gone down so much, we can't go down much more. Yeah, really? We really can. We really, really can. And so there you go. So that was me being a hero and projecting the global financial crisis just from that head and shoulders pattern. And in those days, not many people were doing it. I don't think many people spotted that, and I was a bit wet behind the ears. So so there we go. Yeah, look, this is what we got now. Breakdown, head and shoulders pattern, retest of the 100, and look, this could just be the start of it. That's it, I think, for me. We've done nearly 2 hours. Give me some questions. Anyone got any questions? Or anything else you want me to look at? I've hopefully scared the pants off you, if nothing else. Okay, if there aren't any questions, I'm probably going to finish up. You know how to contact me. Most of you have got my WhatsApp number anyway, or you're in the Telegram group if you're a subscriber, and I know some of you aren't subscribers, just a few of you paid for it. Thank you for paying, thank you for joining me. I really hope it was value for money. I'm going to probably try to do these once a week and charge, because I do the videos on YouTube, but people watch them for 20 minutes. You know, I do a half an hour weekend webinar, they watch them for 20 minutes and they all go off. So this actually makes it worthwhile. I'll do 2 hours and I'll really throw out some good information. So that's it. Thank you. If that is it, thanks for joining me, and I'll try and do one next week. I don't think I'm too busy, but obviously we'll be chatting in the Telegram group before that. Quick one from Craig. Do I look for specific patterns when getting into trade? Yeah, I'm always looking for patterns. I'm always looking for, you know, I'm not great at the patterns. I missed a couple in handle, which is embarrassing, but I'm looking for double tops, double bottoms. I'm looking for the candle formations, you know, the long upper wicks, the long lower wicks, the hammers, and just the basic stuff, the shooting stars. I'm looking for head and shoulders patterns fail a lot, so I do watch for them, but they don't always work. But you can still trade the failure. If the head and shoulders fails, then, you know, okay, that's a buy signal. Just take the buy signal and go with it. It means we're going to rock it, you know. So, but I definitely do look for patterns, candle formations, and as you can tell, the fibs and the trend lines and the moving averages are important to me as well. Okay, if that is it, I'm guessing it is. Thank you so much. It's been a lovely 2 hours. Hope it's been helpful. I'll catch you soon.